I want to talk to you today about the retirement risk that almost nobody warns you about. Not your financial advisor, not your employer, not the government. And it's the one risk that has the single highest probability of completely wiping out everything you've saved. It's not a stock market crash. It's not inflation. It's not even Social Security cuts. It's the moment you or your spouse can no longer fully take care of yourself, and you need help with the basic activities of daily living. That moment, which statistics say will happen to about 70% of people who live past 65, is called a long-term care event, and the financial consequences of being unprepared for it are catastrophic. Today, I'm going to show you the real numbers, not the sanitized version, not the vague estimates, the actual dollar amounts that are hitting real families right now in 2026. And I'm going to show you something that most people in the retirement space aren't talking about yet. A brand new tax rule for 2026 that could make protecting yourself significantly more affordable than you thought. By the end of this video, you will understand exactly what you're up against, exactly what it will cost you if you're unprepared, and exactly what your options are to make sure this doesn't happen to you. Let's start with a number that stops people cold when they hear it for the first time. According to the latest Milliman Long-Term Care Index, the average amount a 65-year-old needs to set aside right now, today, to cover future high-intensity long-term care costs is approximately $141,000. $141,000, just sitting there, reserved, not invested, not growing your retirement income, just waiting for the day you might need it. Now let me put that number next to a number from the Federal Reserve. The median retirement savings for Americans aged 65 to 74 is exactly $200,000. $200,000. That's the median, meaning half of all Americans in that age group have less than that saved. So if you hit the average long-term care need, not the worst case, the average, you're spending $141,000 of your $200,000 on care. That's 70% of your entire life savings. Gone. Not on travel, not on your grandchildren, not on anything you planned for, just on getting help with bathing, dressing, and daily living. And that's just the average. The worst cases can run into the hundreds of thousands or even millions of dollars for people who need care for 5, 7, 10 years or more. This is not a fringe risk. This is not something that happens to other people. This is the most statistically likely major financial event of your retirement, and most people have done absolutely nothing to prepare for it. Now let me show you what the actual costs look like in 2026, because the numbers have climbed significantly and they need to be seen clearly. A private room in a nursing home now averages over $110,000 per year. In higher-cost states like New York, California, or Massachusetts, you can easily be looking at $150,000 to $180,000 annually. A semi-private room in a nursing home is slightly less, averaging around $94,000 per year, but still an enormous sum that drains savings at a terrifying pace. Assisted living facilities, which many people think of as a more moderate option, now average around $64,000 per year nationally, with significant variation by location and level of care. And in-home care, which most people strongly prefer because they can stay in their own home, runs about $30 to $35 per hour for a home health aide. 8 hours of daily in-home care at $32 per hour is over $93,000 per year, and many people need around-the-clock care, which is simply not affordable for the vast majority of families. Even part-time in-home care, say 4 hours per day, still costs over $46,000 per year, and that's money that has to come from somewhere. Now here's what makes all of these numbers even more alarming. They're not going down. They're going up every single year at a rate that consistently outpaces general inflation. Long-term care costs have been rising at roughly 5 to 7% per year on average, which means that if you're 60 today and planning for a care need at 75, those costs could be double what they are right now. A nursing home that costs $110,000 today could cost over $220,000 per year by the time you actually need it. And you need to plan for that reality, not today's prices. Now let's talk about who actually needs long-term care, because the statistics here are sobering and important. Approximately 70% of people who turn 65 today will need some form of long-term care services during their lifetime. That's 7 out of 10 people. The average length of a long-term care need is about 3 years, but that's an average that hides enormous variation. About 20% of people who need long-term care will need it for 5 or more years, and those are the cases that financially devastate families, because 5 years in a nursing home at today's prices is over $500,000. Women are disproportionately affected. They live longer on average, which means they both need care more often and need it for longer periods. The average woman who needs long-term care requires it for about 3.7 years versus 2.2 years for men. And here's the hidden dimension that the financial statistics don't fully capture: the toll on family caregivers. When a formal care plan isn't in place, the burden most often falls on a family member, typically a spouse, a daughter, or a daughter-in-law, who provides unpaid care that can consume decades of their own life. Family caregivers often reduce or quit their own employment, sacrifice their own retirement savings contributions, damage their own physical and mental health, and compromise their own financial future, all while trying to care for someone they love. The true cost of long-term care isn't just measured in dollars. It's measured in the lives of the people who step up to provide care when no other plan exists. So now the critical question: if Medicare doesn't cover long-term custodial care, which we covered in our last video, and most people can't self-fund it, what are the actual options? Let me walk you through every option available to you, starting with the most obvious and working toward the one that most people haven't heard about yet. Option number 1, self-funding. Self-funding means using your own savings, investments, and assets to pay for long-term care as you go. No insurance, no plan, just write the check when the time comes. For people with very high net worth, say $2 million or more in liquid assets, self-funding can be a reasonable strategy because the cost of care, even at the worst case, won't completely wipe you out. But for the median American with $200,000 in retirement savings, self-funding is not a strategy. It's a plan to be financially devastated. The math simply doesn't work for most people. And the cruelest part is that long-term care needs tend to come late in life when you have no ability to rebuild the savings that get wiped out. Option number 2, Medicaid. Medicaid is the government health program for people with very low income and assets, and it does cover long-term care, including nursing home care, for people who qualify. But qualifying for Medicaid means spending down almost all of your assets first. You generally cannot have more than $2,000 in countable assets as an individual before Medicaid will help you pay for a nursing home. That means if you have $200,000 saved, you typically have to spend most of it on care before Medicaid steps in. And by then, your spouse and your heirs have very little left. There is a planning discipline called Medicaid planning that uses legal strategies, trusts, annuities, asset transfers to protect some assets while still qualifying for Medicaid. But this requires working with an elder law attorney well in advance of needing care. Medicaid planning done correctly can protect assets for your spouse and family, but it must be done years before you need care because of look-back periods that can penalize transfers made within the past 5 years. Option number 3, traditional long-term care insurance. Traditional long-term care insurance is a standalone policy, specifically designed to pay benefits when you can no longer perform a certain number of activities of daily living, typically 2 out of 6. You pay a monthly or annual premium, and if you need care, the policy pays a daily or monthly benefit toward your care costs in a nursing home, assisted living, or at home. The major advantage is that a relatively modest annual premium can protect you against a potentially catastrophic expense. For the right person bought at the right age, it's one of the best financial tools available. But traditional long-term care insurance has significant challenges. Premiums have increased dramatically over the past decade. As insurers underestimated claims, many companies have exited the market, and if you never need care, you receive nothing back. The sweet spot for buying traditional long-term care insurance is typically your mid-50s, old enough to have some health history clarity, but young enough that premiums are still relatively affordable and you're likely to qualify medically. If you're in your late 60s or older, traditional long-term care insurance may be very expensive, or you may not qualify at all if you have significant health issues. Option number 4, hybrid life insurance or annuity products with long-term care riders. Hybrid products have become increasingly popular because they solve the biggest objection to traditional long-term care insurance: the fear of paying premiums for decades and never using the benefit. With a hybrid product, you make a lump sum payment or annual payments into a life insurance or annuity contract, and that contract includes a long-term care benefit. If you need long-term care, the policy pays for it, often 2 to 3 times the amount you put in. If you never need long-term care, your beneficiaries receive a death benefit, so the money doesn't disappear. And if you change your mind and want your money back, most hybrid products offer a return of premium feature, so you're not locked in the way you are with traditional insurance. The trade-off is that hybrid products typically require a larger upfront investment than traditional long-term care insurance, and the long-term care benefit may be less generous relative to cost. But for people who have accumulated a lump sum, say $50,000 to $100,000, sitting in a low-yield savings account, repositioning that money into a hybrid product can be an extremely efficient use of existing assets. Option number 5. And this is the brand new development for 2026 that most people don't know about yet. A new tax rule that took effect in 2026 allows you to withdraw up to $2,600 per year from certain retirement accounts to pay long-term care insurance premiums without owing the 10% early withdrawal penalty. Let me say that again because it's genuinely significant. You can now use money from your retirement account to pay for long-term care insurance without the penalty that would normally apply to early withdrawals. You still owe income tax on the withdrawal, but the 10% penalty is waived, which meaningfully reduces the cost of using retirement funds for this purpose. For someone in the 22% federal tax bracket, an unpenalized withdrawal means paying 22 cents on the dollar instead of 32 cents, a 10 percentage point difference on every dollar used to fund your long-term care protection. This makes long-term care insurance more accessible for people who have retirement savings but may not have extra cash flow to pay premiums from their regular budget. Instead of saying, "I can't afford long-term care insurance," you can now say, "I'll fund it directly from my IRA with a penalty-free withdrawal," and the math becomes much more workable. $2,600 per year may not cover the full cost of a comprehensive long-term care policy for every person, but it can cover a meaningful portion, and for lower-cost hybrid products or more modest coverage levels, it may cover the entire premium. This rule is new, it's underreported, and it represents a genuine opportunity for people who have been putting off long-term care planning because of the cost. Now let me talk about some important planning considerations, because choosing the right approach depends heavily on your personal situation. First consideration: your age and health right now. The earlier you plan for long-term care, the more options you have and the lower the cost. This is not a planning task you want to keep pushing off. If you're in your mid-50s and in reasonable health, you have access to the full range of options at the most affordable prices. Waiting even 5 years meaningfully increases your premium and reduces your chance of qualifying. If you're in your late 60s and still in good health, hybrid products may be your best path forward. You may not qualify for traditional long-term care insurance, or the premiums may be prohibitive. And if you already have health issues that would make you uninsurable, Medicaid planning with an elder law attorney becomes your most important protective strategy. Second consideration: your marital situation. For married couples, the stakes in long-term care planning are even higher, because when one spouse needs care, the other spouse still has to live, and the financial devastation of unplanned care can impoverish the healthy spouse. This is called spousal impoverishment, and while Medicaid has some protections for the community spouse, the one who doesn't need care, those protections have limits and don't preserve a comfortable standard of living. Married couples should think about long-term care planning as a joint financial decision, protecting both spouses, not just the one who currently seems most at risk. Third consideration: your family situation. Do you have adult children who could provide care? And have you had an honest conversation with them about whether that's realistic and what it would mean for their lives? Many people assume their family will step in, and many family members step up with love and dedication. But the physical, emotional, and financial toll of providing care is enormous, and assuming it will happen without discussing it is unfair to everyone. A long-term care plan that relies entirely on family caregiving is not really a plan. It's a hope, and hope is not a financial strategy. Fourth consideration: your geographic situation. Long-term care costs vary enormously by location. A nursing home in rural Mississippi may cost $60,000 per year, while the same level of care in San Francisco could cost $200,000. If you plan to retire in a lower-cost area, Your long-term care risk is meaningfully different than if you plan to stay in a major metropolitan city, and your coverage needs should reflect where you actually plan to live. Now let me address the most common reason people give for not planning. I'll deal with it when it happens. By the time it happens, you may not be able to qualify for insurance, you may not have time to implement Medicaid planning because of the 5-year look-back, and your family may be scrambling to find care in a crisis without any preparation. Long-term care planning is one of the very few areas of personal finance where waiting genuinely closes doors. The options available to you today may not be available to you in 5 years. Let me recap everything we covered. 70% of people over 65 will need long-term care. The average cost is $141,000, which represents 70% of the median American's entire retirement savings. Nursing home costs exceed $110,000 per year nationally. Assisted living averages $64,000 per year, and in-home care can easily run $46,000 to $93,000 or more per year, and all of these are rising faster than general inflation. Medicare does not cover custodial long-term care. Your options are self-funding, Medicaid planning, traditional long-term care insurance, hybrid life or annuity products, or a combination. A brand new 2026 tax rule allows penalty-free withdrawals of up to $2,600 per year from retirement accounts specifically to pay long-term care insurance premiums, reducing the after-tax cost of getting coverage. The earlier you plan, the more options you have. Waiting closes doors, increases costs, and could leave you or your family in a crisis with no good choices. If this video opened your eyes to a risk you hadn't fully considered, hit subscribe, because every week I break down retirement money topics just like this in plain simple English. And this is the kind of information that can literally save your retirement. Share this with someone you care about, a spouse, a sibling, a friend who hasn't thought about this yet, because the best time to plan for long-term care was 10 years ago, and the second best time is right now. I'm Bob, this is Retired Not Broke, and I'll see you in the next one. And please, drop a comment below and tell me, have you started planning for long-term care, or is this something you've been putting off? I read every single comment, and I want to know where you are.